This is your LMAX exchange technical update for Wednesday, April 5th, 2017. Eurodollar. So despite this latest round of setbacks, there's a lot of good support in the euro right now down to the 105.80 to 106.50 area. We have the 61.8% fib retracement off of the recent low to high move from the 105 to 109 area, which comes in around current levels around 106.50. And then we have down at 105.80 the 78.6 fib retracement off of that same move from 105 to 109. And in between we have this Ichimoku cloud support with the base of that cloud coinciding with the 78.6 fib retracement at 105.80. The key takeaway here is that despite these setbacks, there is a lot of support here, and the market could easily be putting in a higher low here ahead of the next major upside extension back above the recent highs just over 109, opening the door for a move towards 114 further up. At the same time, if the market breaks down and establishes below 105.80, this key support, it could open the door for an acceleration of declines back towards the recent lows in the 105 area, really at 104.95, below which would expose a move down towards 103.40, a retest of that 17-year low from January. So again, a breakdown below 105.80 would suggest a more significant bearish resumption of this longer term trend. So right now, keep an eye on this area right here to see how the market responds. Sterling dollar. So cable is broken down after once again being very well capped on rallies up towards the 126 area and ahead of that critical December 2016 peak at 127.75, which has defined this latest consolidation, this latest bearish consolidation within a very well-defined downtrend. Right now, though, we would need to see a break back below 23.77 to strengthen the bearish outlook and accelerate declines, exposing a retest of the 2017 low from January. A break below there would then expose the plus 30-year low from October at 118.40. At the same time, if the market pushes back up, it would need to establish above 27.75 to suggest a meaningful structural shift, opening the door for more significant gains, and again suggesting that the market could be putting in a longer-term bottom. But until then, the pressure does remain on the downside and the downtrend is firmly intact. Dollar yen. So dollar yen has been consolidating a little bit since breaking down below a multi-week range support at 111.60. This follows a period of consolidation for much of 2017, a 400-point consolidation between 115.60 and 111.60. And so the breakdown does project a measured move equal in size of 400 points, which would take us down towards 107.60. At the same time, if the market is unable to break down and pushes all the way back above 115.60, that would force a shift in the outlook. But again, until then, any rallies are seen very well capped ahead of what could be additional downside pressure in this market towards that 107.60 measured move. Euro Swiss. Euro Swiss remains confined to a downtrend. Although the market has been kind of mild as far as its downward momentum, the downtrend is nevertheless intact, and a higher low, lower top is now sought out by recent highs that we saw from March at 108.26 in favor of what could be the next major downside extension. But we would need to see a break below 106.24, the 2016 low, which has been an elusive level, to get that fresh downside extension, which would then expose a move down towards the 104 area. Aussie dollar. So Aussie has broken down in recent trade after the market stalled out at 77.50. That's a 2017 high, and into some formidable resistance in the form of that 78 area, which has capped gains over the past several months. At this point, the pressure is on the downside and does favor additional declines down towards recent lows, that March low at 74.92, below which would open an acceleration towards 75 further down. Only ultimately back above 78 would really force a structural shift in Aussie dollar. Dollar CAD. So dollar CAD has been showing signs of basing out after being supported at 132.64. Overall, this is a trend that's been favoring the top side, and so additional upside is favored with setbacks limited. And so this latest 32.64 support, if it holds, could open the door for that next upside extension beyond the multi-day peak at 135.99 and towards 136 further up. Only back below 132.64 would delay this outlook. Kiwi dollar. So Kiwi is a market that continues to show signs of topping out after stalling out in 2016 ahead of 75, and now in 2017 ahead of 74. And now latest round of gains here up towards 71 have been capped, and the market is looking like it wants to roll over. It will need a break below 68.62 to open that next major downside extension, which would expose psychological barriers around 65, and any rallies in the interim should continue to be very well capped, ideally ahead of 72. SPX 500. So we've reached a critical inflection point with the S&P 500. The market is trading just off its record high that was established back in late February, early March, just over 2,400. And so the question now is whether the market is just in the process of a bullish consolidation phase ahead of that next major upside extension to fresh record highs, or if we're in the process of seeing a legitimate onset of a correction lower in this market. So this latest rally that we're seeing would need to stall out, though, in order to confirm the possibility for a more significant correction, stalling out below the previous lower top, which is around 2390, and that will be confirmed if the market breaks down and takes out 2320. If we take out 2320, it will really do a good job of solidifying the corrective process here, opening the door for deeper setbacks towards a measured move at 2270. If, on the other hand, the market is unable to establish a break back below 2320, it will keep the bullish structure intact, opening and suggesting a fresh upside extension to record highs beyond 2400, possibly up towards 2500. 2485 is a key level in the S&P 500. Gold. So gold continues to show signs of basing out after putting in a low just shy of 1100 in 2016. We have seen a higher low now at 1180, which was confirmed on a break recently up towards 1265, and this latest round of setbacks now should ideally be supported above 1180 at 1195, where the next higher low is sought out ahead of a fresh upside extension, which will be confirmed on a break above 1265, opening the door for a measured move up towards 1335, just shy of that 2016 high at 1375. If we do see any setbacks, which are possible, they should be very well supported above 1195, but ultimately only a break back below 1180 would negate the constructive outlook for gold.